Today, we will talk about 15 things that are mutually exclusive in life. Starting a family means creating a shared life based on your goals and values. If something happens to you, your partner may not be able to hold everything together alone. The burden can be especially heavy if you have children. Life insurance can provide you with confidence that if the worst happens, the people who depend on you will be financially protected. The right life insurance policy can help your family maintain its financial obligations. 1. Term life insurance. Most of the time, when you're researching different types of life insurance, you'll be presented with two main options: term life insurance and whole life insurance. What many people don't realize is that these are more like general categories, and there's still a lot of variation to consider. Term life insurance is one of the most popular types of life insurance. It offers death benefit protection for a specific time period, such as 10 years, 15 years, or 20 years. Because it only pays out in the event of the insured's death, term life insurance is also a very affordable way to obtain coverage. You pay a premium during a specific length of time, the term. If you die during the term, your beneficiary receives a death benefit. If you don't, the term ends and you get no cash value or other payout from the policy. A 20-year term is popular because many families use term life insurance as protection while their kids are growing up. Term life is typically used to replace the income you would have contributed toward housing, education, or lifestyle activities like extracurricular sports for the kids. 2. Permanent life insurance. This is an overarching name for life insurance that lasts your entire life instead of expiring as term life insurance does. With a permanent life insurance policy, you can't outlive your insurance protection. Even if you live to a ripe old age, the insurer will pay a death benefit to your beneficiaries, as long as you're up to date on premium payments and there are no outstanding policy loans. Because these policies last your whole life, they often have higher premiums. 3. Whole life insurance. Whole life insurance is one of the most common permanent life insurance options. It offers consistent premium payments and a guaranteed interest rate on your cash value. Since this is a type of permanent life insurance, you can expect the monthly premiums to be higher than a term policy with similar coverage. Keep in mind, though, that if you continue to buy term life insurance over time, for example, your term expires, so you buy a new term policy down the road, when you're older and face higher rates, starting with whole life might make sense. 4. Universal life insurance. Universal life is another type of permanent life insurance. Universal life insurance provides more flexibility than whole life. It may allow you to adjust the death benefit without opening a new policy, subject to the terms of the contract. You can potentially increase your death benefit down the road too, if you pass medical and any other requirements. 5. Variable life insurance. The variable factor of this type of policy is the rate of growth of the cash value. Instead of earning interest at a guaranteed minimum rate, as you would with a whole life policy, variable life insurance invests part of your premium in a select set of mutual fund sub-accounts. There's more potential for growth, but also more risk because your money is subject to market risk. You may also have the option to allocate a portion of the funds to a fixed account not subject to market fluctuations to incorporate a layer of protection from market declines. 6. Variable universal life insurance. As the name suggests, this option combines features from variable life and universal life insurance policies. This kind of policy lets you adjust the death benefit and premiums, like universal life insurance, and also gives you the growth opportunities that come with investing in market funds, like variable life insurance. 7. No-exam life insurance. When people refer to no-exam insurance, there are a few different things they may be talking about. Some come with a higher price tag or limited coverage, and others don't. Accelerated underwriting isn't really a type of insurance per se, but a feature for some policies. 8. Simplified issue life insurance. If you're over 50 or even in your 40s with some health problems, buying life insurance can get tougher. Depending on your age and health, it can sometimes be difficult to find an insurer to sign you on for a policy at all. 9. Guaranteed issue life insurance. If qualifying for life insurance is a serious hurdle, guaranteed issue takes things a step further than simplified issue. Almost no one gets declined for this kind of policy, so it's helpful as a last-ditch resort. Because they are guaranteed issued, these policies tend to be more expensive for the same amount of coverage compared to non-guaranteed policies. In addition, guaranteed issue policies typically have graded benefits, which means that the payout would be reduced if you pass away during the first 2 years of coverage. 10. Final expense or burial insurance. This is essentially another name for a term life insurance policy that's been scaled to pay for a funeral. Policies generally provide up to about $20,000 as the benefit. Despite the name of the policy, beneficiaries can use the payout for whatever they want, not just funeral-related expenses. This could be a good option for families that would struggle to cover final expenses on their own. 11. Group life insurance. In most cases, this refers to life insurance that you can get through your job as an employee benefit. You may receive a certain amount of life insurance for free through work, plus you might have the option to purchase additional coverage. For some people, group life insurance can be an affordable way to get coverage quickly. That said, there are many drawbacks to relying on your job for life insurance. 12. Mortgage protection insurance. Mortgage protection insurance, also sometimes referred to as mortgage payment protection insurance, pays off your mortgage if you die. In some cases, these policies might also cover all or some of your mortgage if you lose your job or become disabled. The big difference between mortgage protection insurance and traditional life insurance is that mortgage protection insurance doesn't pay an individual beneficiary. 13. Accidental death and dismemberment. Insurance accidental death, AD coverage, covers you in the case of, an accidental death. In other words, death caused by an accident such as a car crash would be covered, but death caused by an illness such as cancer would not be. With this kind of policy, if the policyholder meets the age requirements, they're guaranteed approval regardless of their health. The coverage is instant, without any medical exam. 14. Credit life insurance. This kind of life insurance is specifically for people with debts, such as a home equity loan. With this insurance, if you pass away, the insurer will pay your lender. In that way, it's similar to mortgage protection insurance. The main difference is that the loan in question doesn't necessarily have to be a mortgage. 15. Joint life insurance, survivorship insurance. This type of insurance insures two people at once. Usually these are spouses. Under a first-to-die policy, the insurer pays out after the first policyholder passes away. After that, the policy expires and the second person wouldn't be covered in case of death. Under a second-to-die policy, the insurer would pay out after both policyholders die. This would, for example, provide for a dependent after both spouses are gone, or cover estate taxes. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.